Thank you. Good morning, everyone. Thank you, Jan, for these nice words. Cool guy. That's always nice to hear. And thank you very much for giving me the opportunity to present once again at this Ecosummit conference. I think it's a great occasion that we're celebrating this 10th anniversary of the Ecosummit to make a little pause and look at what, from EIF perspective at least, what the Cleantech VC market has achieved so far, what are the financial results, what have been the lessons learned so far, and how, at least from an EIF perspective, will be going forward. I will not spend too much time because I have only 10 minutes and the clock is ticking in explaining who EIF is. I've done that at multiple occasions, but we're basically the venture capital arm of the European Union. We act as a fund-of-fund investor. And so we invest in VC funds with mainly the support of the EIB and European Commission. And actually, I'm not here alone from the EIB group. I have some colleagues from the EIB. Marc Agrin should be in the crowd. Marc, are you somewhere there? If you could raise your hand. Marc maybe did not arrive yet, but basically, if you're a startup company in your growth stage, please talk to Marc. He has some financing tools to support you. If you're a VC fund raising money, like Jan, please talk to me. So, in a nutshell, what has been the support of EIF for the cleantech industry? We started investing in pure play cleantech funds when they merged in 2006, 2007 roughly. And since then, we have invested close to 600 million euros, so basically 585 million euros in some 23 VC funds managed by 17 fund managers. And those funds so far have raised some 2.8 billion euros and have financed some 220 portfolio companies. And the number of portfolio companies backed by these VC funds continue growing because many of these funds are still in their investment period and constructing their portfolio. So how to look at it? I have made a parallel to what Richard Youngman did a couple of years ago by segmenting the market into 3 waves. He did that in terms of business model of underlying companies. I have done that with regards to our VC funds. So the first wave of VCs investing in cleantech was made by basically generalist ICT and life sciences funds. So generalist funds investing either in software and hardware or in life sciences, and it happened that sometimes they would invest in a company which would be qualified as cleantech. So that was the first wave of VC funds. The second one is the pure play cleantech funds, as we call them. They had been raised starting from 2006 with a focus on cleantech, sustainability, investing in a various type of business models, various types of industry. So you would find in a single VC fund investing in cleantech, software, hardware, semiconductors, alternative polymers, industrial biotech, but they were the pioneers in investing in cleantech. And then since 2012, we have what I call the third wave. So the third wave of VCs who have learned some lessons from their past experience, sometimes their painful past experience, and who have refined their investment strategy. So what is this refinement of the investment strategy? Either they have narrowed down their focus to very specific verticals, very specific industries, or very specific business models of the cleantech industry and the cleantech market, or they have left completely the technology risk. They have moved later stage, are not investing in companies where there is a technology risk, but investing in companies which are already generating turnover and profitable. And that is the new generation. So now we'll do a very quick, hopefully deep dive, but in a very short moment, about what has been the financial performance of the VC cleantech ecosystem in Europe. And you can see and focus on the red figure, it has not been glorious. When I look, the sample of the data comprises 14 funds raised between 2006 and 2013, focused on cleantech. I have stopped looking beyond 2013 because those funds are still in their investment period. So 14 funds in which we have committed some 333 million euros, and those funds have raised 1.5 billion euros. In the segmentation of the portfolio that I presented earlier, there are 10 funds which belong to the Wave 2, 10 funds which have raised 1 billion euros, and 4 funds in this Wave 3, this new wave of clean tech investors which have raised 515 million euros. And segmenting the performance according to these two categories already brings us some interesting information. The first or the second wave of investments, so the first pure play clean tech funds raised in 2006, have generated 0.86 times TVPI. So a negative performance so far. There might be still some improvement because there are still some companies left in those portfolios which are unrealized, but let's name it, we will not generate a 2 times return. Nevertheless, on this Wave 3, this new generation of funds who have adapted their business model and approach to the market, we have actually 2 funds which are generating a double-digit net IRR. 2 clean tech funds, 2 funds focused on sustainability, which have a performance of more than 10% net IRR and a TVPI globally on these 4 funds of 1.2 times. So the market reality is that the market in VC has become quite competitive. In Europe, today, we have 70 funds across ICT, life sciences, and clean tech, which are generating more than 10% net IRR. And out of these 70 funds, we have 2 funds which are focused on sustainability. So definitely, if we want to become a viable asset class and attract institutional investors to support the VC funds investing in clean tech and sustainability, we have to level up our game and generate finally a risk commensurate return performance and according to the expectations of the institutions. So what went wrong, and this is our perspective from EIF? I think the first one, and this has been commonly shared and often shared with the clean tech industry, clean tech and sustainability are not sectors. They are investment themes which encompass various sectors, various industries, various verticals, and it is very difficult, often very difficult for a standalone VC team with 3-4 partners to understand in-depthly all the pitfalls, all the issues associated to the value chain, especially if you're mixing industrial biotech and life sciences together with some ICT and software companies in your portfolio. By the way, the history of VC in Europe has shown to us that mixing ICT and life science together doesn't work. The majority or all of the funds which used to do that in the past have split and separate ways. We have now separate ICT funds and you have separate life sciences fund. The second lesson learned, and again, this is from EF perspective, is that the business models that the funds were initially targeting were ill fit to the VC model. And the VC model has very strong 2 peculiarities. The first one is a limited amount of money. You raise the money, you reach your final closing, and this is the money that you have to live up with for the next 10 years. So you'll not be able to do everything that you want with that limited amount of money. And some of the companies are extremely capital intensive, and we found that there were some companies which were too capital intensive for the financing available for these VC funds. The second constraint associated to VC is time. When you raise a fund, the lifetime of your VC fund is 10 years. And a lot of the companies actually included in those VC portfolios required much more time than the 10 years limitation of the VC fund. And finally, the third, and I think this is the most important point, is that there was a lack of real impact. There were too many technologies which were cool technologies on the face of it. You look at it and you say, wow, this is really cool. This is really great. But when we made an more in-depth assessment about what is the real environmental impact of those companies, we realized that it was pretty limited. There were cool technologies, but with very little appetite on the market because the impact was either small or because the cost-benefit didn't make sense. They were too costly compared to traditional technologies which were not clean tech. So this is pretty negative and tough news to start the morning. So the question is, do we have hope that the industry will improve. And I'm a strong believer that hope is there. We have also been at EIF investing heavily in the life science industry. And 10 years ago, 15 years ago, you would say life sciences to institutional investors, all of them would leave the room. They say life sciences doesn't work, it's ill-fit for the VC model, binary outcome of the portfolio, binary outcome of the technologies, too capital intensive and too time consuming. Nevertheless, 15 years down the road, today, the life science industry is the most performing asset class, most performing industry in the portfolio of EIF. And there we have now a large number of VC fund managers who've managed to find the trick to invest in life science in a very profitable way and generating a 13.7% net IRR. So the focus forward is that EIF will focus on team who understands the underlying technologies that they're investing in, but also teams who understand the constraints of managing a VC fund. Limited amount of time, limited amount of cash. This is related to portfolio modeling. It's not about only investing into companies, but creating a portfolio which would generate financial success for the investors. And finally, genuine impact strategies. We will avoid fund managers who are labeling themselves as sustainable funds or clean tech funds just for the greenwashing and raising money. So in order to do that, and in order to make sure that we are investing in real, and this is my last slide, that we're investing in real, genuine impact investor who are here to generate a sustainable, positive impact, and at the same time, and thanks to that impact generating a profit return, we have adapted an impact investing methodology that we have developed at EIF. 4 or 5 criteria: profit always as an objective, intentional, predetermined impact, positive correlation between the impact and the financial results, and finally, and very importantly, measurable impact. And if you put all these ingredients together, we're pretty sure that this will induce a positive change to the society and a positive change to the clean tech industry. Thank you very much for your attention.